Today, we're going to have a look at something a little bit different. We're going to focus on a rules-based strategy that actually can really help you understand how to develop a mechanical trend following strategy. And then for the trading takeout, we're going to look at the best ways in which you can actually trade the NFP. But first, make sure you like this video and subscribe to the channel to let me pop up in your YouTube feed every day, giving you the best market commentary, tips, and tricks so that you can improve your trading edge. So in front of us, we've got Novo Nordisk, and I'm only looking at this because it's a really strongly trending stock, and I've used this strategy specifically on this this stock as well. And there's a couple of rules when it comes to trend following, and it's pretty much that you ignore the short-term noise, you focus on the daily chart, and you ensure that you're very stringent with your entries and exits. Now, you'll see what I've got in front of me. We've got the 200 daily moving average in blue. We've got the 50 daily moving average in green, and then the yellow is the 20 daily moving average. Now, the way that this strategy works is whenever you have a daily close that is above all three moving averages, okay, like when it's arriving from below one of them, okay, then you buy. You have to wait for the close. And then when it drops below the 50 daily moving average, so the green one, is when you close that position out. And you repeat that. You keep repeating that, okay? And it's a very simple method of trend following. And you're probably going to use it only in maybe the top, 50 stocks, perhaps, because they are the ones that tend to trend the most. They're the most heavily weighted in the S&P 500. And also on the S&P 500 or the NASDAQ itself. So these are the asset classes that you want to do it in. But if you have a look, so I'll show you a specific example. You would want to buy here, okay, close above all three, and then you would want to sell here. You'd want to buy here, and it doesn't matter if it closes out below. You would sell there, and then you would buy again here the day after, but then you would close out here. And really all you're looking to do is, it doesn't matter the amount of times that you get closed out, okay? What matters is that when you do catch the market going, so here, for example, you'd have been chopped up all around here. This is when the actual trend can start to begin and proliferate, right? And you capture that move and then close out here. And you just keep doing it until you get to the adequate point where the market is sufficiently moving. You're going to get closeouts, but the point is to be entirely rules-based. You could optimize it even more, and you could say, okay, I'm going to get out whenever it crosses under the 20 daily moving average, which is a faster period moving average. But then that leaves you to more susceptibility of chop. Okay, so if the trend really does start, it will go up and down, but really you want to be exiting on the longer term moving average. So try that. It's very much rules based. Try it with small position sizes and see how you get on. But it has to be over the longer duration. It can't be an intra-week thing or intraday. It just doesn't work like that. It's much better to look at the longer term trend, because that's how they're going to proliferate over time. So it's NFP this Friday, and something I really want you to watch for is something I like to call the heartbeat monitor pattern. And it's basically when the data is released and the market swiftly goes to the upside, and then it comes back down to the middle, and then it goes to the downside, and then resettles in the middle. See, there's something in that you can really take and use to your advantage. And it's that the market is only going to go in FX, especially with FX volatility so low, it's only going to go a certain amount before it mean reverts. The market mean reverts about 70% of the time in FX, and trends about 30% of the time. So something that you can really use knowing this is that if the market is going to tick up to an excessive amount, you could probably sell that back down to the middle. That's called mean reversion because it goes back to the middle, and then possibly do the same if it starts to go the other way as well. You probably want to use a smaller position size to do this. You don't want to aggress too much. You don't really want to, get into the market with a lumpy amount of size. But something that you can really, really capture there is if the market is weirdly going the wrong way as well. So let's say, for example, you get a really, really big beat on the NFP and the dollar starts falling for some reason, should really increase because that would lead to interest rates being higher for longer, then you could possibly look at buying the market at a certain, limit level, and then wait for it to get back higher and then get more aggressive if it does then push higher. Or if the dollar increases in value. But really watch out for that heartbeat monitor pattern, and make a note if you see it. You don't necessarily have to try anything this Friday, but if you do see it, then make a note and see if you can utilize it for next time.